Everyone's talking about interest rates, inflation, and construction costs, but almost no one is talking about the thing that actually determines whether your project lives or dies. What is it? Zoning. By the way, if you want to stay plugged in to real estate trends, commercial investing insights, and build to rent strategies almost no one else is covering, hit that follow button so we can stay connected. Here's the truth. Zoning is the gatekeeper. Before you raise equity, before you lock in debt, before you even buy the land, zoning decides whether your deal prints money or eats your lunch. I've been a part of many of these where the developer bought the land and didn't do enough due diligence on whether the zoning will work. So today, I'm going to break down this way in a sense that an 8th grader could follow. And by the end, you'll understand exactly how zoning changes the math for single-family rentals, multifamily projects, and for those of us developing BTR communities. Now, let's talk about zoning. Zoning is simply what you're allowed to build and where you're allowed to build it. Super simple. Think of it like lanes on a highway. Some areas, 1 lane, only single-family homes. Some areas, multi-lane, townhomes, multifamily, mixed use. Some are toll lanes. You can build, but only after paying studies, hearings, impact fees, and a year of pain of your life. Now, most investors think zoning is a simple yes or no. Not the case. Zoning is really a spectrum of how dense, how tall, how many units, parking spaces, how much green space, and of course, how fast the city will let you move. The big misunderstanding. Here's where people screw this up. They think zoning only matters when buying land. Nope. Zoning impacts all of these things. Your loan sizing, your appraisal, your construction timelines, your absorption, your operating income, your exit cap, and whether the city slaps you with conditions that turn your pro forma upside down. Case in point, hey, I've got a development agreement, and now I have got housing units that we have to have in here. It means a lot. Zoning isn't a line item. It's the foundation of your entire capital stack. Here's the domino chain. 1, land is zoned for certain density. This determines how many rentable units you can build. Density determines revenue. Let me say that again. Density, especially how much land costs these days, determines your revenue. Now, most developers want to get as dense as possible because the cost of land is so expensive. So more units equals more income equals more loan proceeds. So revenue determines valuation. That valuation determines your equity, which makes money or burns it. But here's the twist. Cities are under pressure. Housing shortages, NIMBY pushback, infrastructure constraints, all of that impacts what zoning they'll approve. So a project pencils today can be dead tomorrow if a city decides to review its zoning code. That's how much power they hold. Let's talk single family. Zoning reforms like ADU approvals or reduced minimum lot sizes can open the door for small-scale investors to add real density. But in many markets, strict single-family zoning still blocks supply, keeping rents elevated. Now, in Utah, the state has actually allowed for ADU and approval on your lots. So that's some of the changes that we're starting to see, and that's most recent. Now, multifamily. Think about this. Higher density zoning can make or break a deal. If a city bumps you from 20 units per acre to 30, your loan proceeds can jump by millions. But if they cap height or tighten parking requirements, your deal loses feasibility overnight. Let's get into build to rent, my specialty. This is where zoning becomes the secret weapon, okay? Because BTR sits between single family and multifamily, okay? It's this hybrid model. Love it. Many cities don't have a category for it yet, and they like it. You get best of both worlds. A single family, all rentals. Some treat it as single family, good. Some treat it as multifamily, bad. Some have no idea what to do and default to endless reviews. Disaster. Developers like us need to operate 2 steps ahead of zoning conversations. because whoever gets entitled first wins. So doing your due diligence, becoming friendly with the cities, and painting a picture is your best case scenario. So let's look ahead. Over the next few years, zoning is going to be the hottest battlefield in real estate. Let me say that again. Zoning is going to be the hottest battlefield in real estate. More cities are fast-tracking density to hit housing goals. Now, it's up to us to talk with those cities and break through some of that red tape so we can build. Let developers develop. Others are tightening controls because of traffic, schools, and citizen pushback. That's a big one. Citizens don't want multifamily next to their homes or even rental communities. And federal incentives are quietly rewarding cities that open zoning for more housing types. If zoning tightens, land values stall, timelines explode, and only the most experienced developers will survive the entitlement maze. Either way, zoning is going to shape who wins the next cycle. So here's the bottom line. Every number in your pro forma, every dollar of revenue, debt sizing, and return comes from zoning long before it comes from the market. I want you to drop your thoughts below. Do you think cities are going to loosen up zoning or crack down harder over the next few years? If you want to see how we're navigating zoning challenges inside our BTR communities right now, grab the case study at coreyboner.com/case study. And if you want another video that might save you from a zoning disaster, watch this one next.